Welcome back, traders. It's expected to be a busy week of central bank meetings. The Fed is expected to cut interest rates by 1/4 percentage point on Wednesday. The ECB could stay on the sidelines on Thursday, and the Bank of Japan may also keep interest rates steady, but questions are rising about when it's going to raise interest rates again after the election of a pro-stimulus prime minister. But the central bank meetings will not be the only market-moving event. Tech earnings could add extra volatility, particularly on Wall Street, but crypto markets could also gain extra volatility on the back of earnings releases, given the positive correlation between cryptos and US indices. So at this video, I'm going to break down dollar yen, euro dollar, and Bitcoin against the US dollar, and starting first with dollar yen and the Fed. Everyone is widely expecting a 25 basis point rate cut in the US. December's policy meeting could also deliver an equivalent rate cut. So more or less rate cuts in the next by the end of this year are priced in, and what we are waiting to see is whether there is intention for additional rate reductions in 2026. However, at this week's policy meeting, there will not be any rate projections or fresh economic forecasts, so probably it might be a neutral policy meeting, particularly as President Trump continues to use an aggressive tone on the tariff front, and as government shutdown is making additional data releases. The timing of next data release is uncertain. So from a technical perspective now, a new prime minister in Japan has been the main driver of dollar yen's recent rebound. The new prime minister is considered a pro-stimulus leader, and it has already proposed an agenda that could cost more than last year's budget. Now, this is also already priced in, and probably what remains to be seen is whether the Bank of Japan's policy stance may change following the election of the pro-stimulus leader. So I expect the Bank of Japan to be a bigger market-moving event for dollar yen. However, from a technical perspective, the risk is looking more to the downside, given the fact that the stochastic oscillator over here seems to have peaked in the overbought zone above 80. That increases the odds for a negative move, which could drive the price towards the 151.15 and 151.60 territory. That's where the 61.8% Fibonacci retracement level of this downfall is placed. The 20-day moving average is adding extra importance to this region, and we can see that this line has been protective a couple of days ago, so it will be closely watched. If we fail to hold here, I expect a sharper decline towards the 50% Fibonacci of 149.37, where the 50-day moving average is converging. We can also see that we have a golden cross between the 50 and 200-day moving averages. That's a positive sign that perhaps this uptrend may continue, but that will probably depend on the Bank of Japan's policy stance and whether it's still willing to raise interest rates independently on the fiscal policy. Now, in the event of a bullish continuation, while the 153.80, 154.80 zone might add strong pressure on the price. There are a couple of resistance lines that could block the way up. If the price manages to close above this region, then we may see a fast rally towards the 156.70 barrier taken from January 2025. Now looking at euro dollar and the ECB's policy meeting, policymakers are not expected to cut interest rates further, at least not in the year ahead. So perhaps the policy meeting may not be eventful. Nevertheless, we have key data releases out of the Eurozone which could test the ECB's policy thinking. GDP growth figures for the third quarter and flash CPI inflation numbers will be out during the week, so those could probably provide some insight about whether the ECB is on the right policy path. Well, according to forecasts, GDP growth is expected to slow down a bit to 1.2% year on year in the third quarter. CPI inflation could also remain very close to the ECB's 2% target, suggesting no drastic policy measures at the moment. However, if we have negative surprises, then that could cause a decline in euro dollar, which is currently remaining supported above the 1.1550 and 1.1570 territory. Well, the fact that the 20-day moving average has been a key barrier to upside movements that keeps downside risks intact. Nevertheless, if we look at the technical indicators, they are all sloping. They're all showing some improvement, so that could keep upside pressures in place, although we need the RSI to move above 50 to become more optimistic about potential upside movements. So in the meantime, the risk is neutral, and we are waiting to see whether the price will break above its simple moving averages over here and move beyond 1.1645, 1.1685 to retest the 1.1765 territory, which includes a couple of key broken support trend lines, and then a successful penetration here could trigger a nice rally, probably towards this key tentative resistance line, which connects the previous highs seen near 1.1960. Now, if downside pressures push the price below these 1.1550 and 1.5070 zone, then there are no major support levels until the 1.14 territory, where the price will experience the nice rebound back in July. Below that, the 200-day moving average at 1.13 could be the next target. And finally, looking at Bitcoin against the US dollar, which also faced a really constructive session last week. It seems that crypto markets keep a strong positive correlation with Wall Street. US import tariffs seems to be not really affecting US indices, nor does the government shutdown. So it seems that the recent rebound is mainly driven by the AI factor. Investors are paying close attention to promising returns on the AI front, and that could be the case this week as well, as important big US tech companies are reporting their financial statements throughout the week, including Apple, Meta, Alphabet, and Amazon, among others. So we are expecting to see whether they will provide promising AI insights and drive this rebound over here higher. In the meantime, what we are waiting to see is whether we're gonna get a close above the 114,650 level, where the former support trend line is located. We have seen this line acting both as support and resistance previously, so I would like to see a clear close above it, which also coincides with the 78.6% Fibonacci retracement level of the uplift that started in April. So once we close above it, we could retest the 170,000 level once again. That was also a key barrier during previous sessions, and then above that, all the attention will turn back to the 120,000 psychological mark, where a successful penetration higher could then reach again the 123,000 important resistance zone, which blocked July's rally and also August's upturn. Well, from a technical perspective, if we look at the technical indicators, they're all sloping upwards. We have yet to reach, the indicators have yet to peak in the overbought zone, so that provides some optimism that this rebound over here could extend further. Nevertheless, if we fail to close above the 140,650 level, then I expect some consolidation, even a pullback that could drive the price as low as 106,220. That was a key base to this rebound back in earlier this month. And then below that, we still have some protection near the 104,070 territory, near this tentative support trend line over here, which could keep the price in a sideways pattern. If not, then the 50% Fibonacci mark of 100,130 level, that could be the next target on the downside. And it's important to know that this area has been quite protective back in June, where the price managed to rebound and head towards the 120,000 territory. So that's everything I wanted to share with you guys. Thank you for watching and see you next time. Bye bye for now.